And that's really the sort of core of my impact investing experience, looking at ways that I could use capital in order to help businesses grow, to create jobs, to improve food security, fundamentally to give people improved opportunities in life. The difference between impact investing and normal investing is that the investor is being specific and intentional about the positive impacts that they want to achieve.
Hi, Tom. Very welcome to the Sustain, Change and Grow podcast. It's my pleasure to have you. And we will talk a lot about the impact investing, everything you have been doing for the last, 20 years. Could you please introduce yourself and say how you became an impact investor?
Yes, sure. Thank you, Delara. I've been an impact investor for as long as impact investing has been a thing. My journey began, I suppose, in 1997 when I joined the British DFI, which is now called British International Investment. It was previously known as CDC. And I worked for BII for about 5 years. And my roles were very much focused on the investments that BII had made in agricultural assets in sub-Saharan Africa. So came into that role. So I spent quite some considerable time living and working in Tanzania and Zimbabwe. Previously, I'd worked elsewhere in Africa, and it was very much my belief and desire, and this I think still motivates me today. The private sector, well managed, can be a really enormously valuable contributor to sustainable development. In fact, in many ways, it's the only contributor to sustain. It is the only form of sustainable development. My journey with BII then led me to establish an impact investing fund based in Uganda, but focused on East Africa. The fund was called African Agricultural Capital. And I established that with the support of the Gatsby Charitable Foundation and the Rockefeller Foundation in 2005. And I spent 14 years living and working in Uganda, covering East Africa. And that's really the sort of core of my impact investing experience, looking at ways that I could use capital in order to help businesses grow, to create jobs, to improve food security, fundamentally to give people improved opportunities in life.
Private capital is the only form of sustainable development?
Well, I suppose what I mean by that is that without the private sector generating value added, creating markets, creating opportunities, what else do you have? What other source of revenue is there? What other source of wealth creation? What other source of opportunities? You could say the public sector can deliver those things, but in practice, the public sector needs the private sector in order to have access to the revenue it needs to pay its expenses, to make its contributions to society. I suppose my view is that without a thriving and healthy private sector, you're very unlikely to have an economy which is sufficiently robust, sufficiently strong in order to create the jobs and the opportunities that people need.
And so, what is impact investing?
I mean, put very simply, impact investing is investing for a return, but also investing for the measurable positive impact. So it's the intention to create impact alongside earning a financial return.
Is there something which is more important than the other?
The critical part is the intentionality. Investing generally, particularly when you're bringing new capital, additional capital, is likely to be, it will certainly be impactful. The difference between impact investing and normal investing is that the investor is being specific and intentional about the positive impacts that they want to achieve, and indeed in managing the negative impacts that their investment or the company that they're investing in may have. So, I mean, let me give you an example. So, an impact investor might say, so my impact investors, when I established African Agricultural Capital, what they were concerned with was two factors. They wanted to, through the investing activity of the fund, they wanted to reduce food insecurity, increase food security in East Africa, and they always also wanted to create a demonstration effect to other investors to say, yes, look, if you invest in small and medium-sized enterprises in East Africa and you choose those well and you support them, not only can you actually generate a return on your investment, but you can also demonstrate the positive impact that these organizations have on the communities that they work with.
And how can you measure this?
Obviously, it's always challenging to measure impact. There's a lengthy debate that goes on around the attribution of impact, the contribution of the investor to the impact being achieved, and I wouldn't want to I wouldn't want to say that is a simple task. Where I think it is relatively straightforward to measure impact is to look at growth post investment. So if you invest, let's say you invest $1 million in a business, and that's new money. It's not replacing. All of that money is going into expanding that business. You can then look at the performance of the business pre-investment and post-investment, and you can quite reasonably, I think, attribute quite a lot of subsequent growth to the impact of the investment that you've actually made. So if I look at that, if I take for example, as I can do indeed, if I take for example a seed company in Uganda, a company producing agricultural seeds for farmers, we know what sort of how much seed was being produced pre-investment. We know that has increased by 3 or 4-fold over the course of the last 5 years. And we know that without the investment that went into the company, it would have been very unlikely to be able to grow at that level. So then you can then talk about the sort of marginal gains attributable to the investment that you make. And you could, of course, look, and in terms then of broader impacts, you can look at the increase in employment, you can look at the increased volume of seed being sold in the marketplace, and so on.
Can you say then that the safest bet for impact investing is to invest in startups, no, completely new companies?
I mean, that is, what I would say is that that's perhaps the easiest form of impact to measure, because obviously you can attribute all of the company's performance to the initial investment that has gone in. So startups are definitely successful. Startups are clearly highly impactful. I don't think there's any question about that. I wouldn't want to say though that's the only form of impact. But I think the strongest form of impact is where you're investing for growth and expansion, and you're bringing new capital to a business.
Then shall we see most of the impact investments going to Africa? Because that where would be the most of the need and the additionality and intentionality of these investments to make it grow.
I would argue that that probably the highest impact quotient, if you like, or the highest impact multiplier, is probably achieved by bringing new money to to frontier, to smaller, to weaker economies. I mean, I think it's probably reasonable to say that that's where you will get your largest multiplier from the investments that you make. I wouldn't say that's not necessarily Africa. That could be in other
Yeah.
markets, in other um, uh, lower income countries around the world. But I think it would be a mistake to sort of say to make that a rule. Um, I mean, I'll give you an example. There may be many. I'll give you. I mean, particularly in relation to, let's say, climate investing. Many impact investors will have a climate thesis for their impact. They will take the view that what they have to do, that if they are able to invest in, let's say, decarbonisation or the move to net zero, and they will be able to quantify the impact that they're having. So they'll look at building portfolios around new technologies designed to get us to net zero. And those companies, that sort of investing could take place anywhere in the world. In fact, you could argue that the best place for those investments to take place would be in the highest carbon emitters, and therefore an impact investor with a climate lens, a climate focus, might well conclude that the best place they can invest is, let's say, in North America, where everyone says that that's responsible for the highest emissions per capita in decarbonisation technologies. So I think you have to look at what the intention is, what the intention of the impact is, and then make your judgment about how you can invest that most efficiently and effectively.
How big is the size of the impact investing market?
It's grown a lot over the last 10 to 15 years. Um, we were talking at what we're now talking about impact investing levels over a trillion, so more than $1 trillion of capital is invested in impact. Um, Obviously, that's still very small in the context of global investment levels. But what we are seeing is significant growth, and significant growth not only um, among the sort of population as a whole, but significant growth in interest from institutional investors who are handling, pension fund, managing pension funds, and managing our money. And I think what I think is really encouraging is that growth has been it's been very rapid. I mean, 4 years ago, we were talking about assets under management in perhaps of around 400 to 500 billion. Over that period, over the last 4 years, that's now more than doubled, so that we're now over the trillion mark. And if we continue at this kind of pace, then I think it's not unrealistic to assume that we're going to have impact investing making up 10 to 12 trillion over the course of the next 10 years.
There is quite a bit of greenwashing, right? And now we hear also a lot about the impact washing, and every fund is well, impact fund, or is looking for creating an impact. So, and this 1 trillion US dollars, is it like true impact investing money?
Well, I think that's a good question. I think there's not a conclusive answer to that question, because there's not as yet a sort of system of verification, of reporting and verification and identification and measurement and so on. There's not yet a sort of a best practice framework that enables us to say with confidence that all of that money is invested in real impact. So your question is right, to say, well, is that a source of concern? Yes, it is. Is there a concern that some of that we may see impact washing in the same way that we see greenwashing? What I would say to that is that the impact investing sector is very well aware of those risks, and at the moment there are a lot of efforts going underway in the impact investing community to ensure to reduce the risk of impact washing, and ensure that there are that the integrity and the trust in which people place in it are not misplaced. So, can we do that? Can the impact community do that itself? Is there a need for a sort of enhanced regulatory framework to ensure that the claims of impact are genuine and not impact washing? The answer to that question, I think we have to be honest, and we have to say that the answer to that question is not yet clear.
And what is your personal feeling, like from talking to the community? How do you assess? Is it more genuine interest in creating the impact, or it's also just being sexy?
I think there's a mixture. It would be, it would be surprising if there was not a degree of opportunism, and there were not certain people who would want to jump on the impact bandwagon and say we're offering something. I think it would be naive to assume that that was not the case. My own experience is that certainly the vast majority of people that I speak to and interact with are serious about genuine positive impact. Where I think perhaps another important aspect of this is as well, and this is perhaps where I slightly differ in the way that I think about impact. Not many people would share these views, I think, but I think by far the greatest impact is governed by the question of additionality. Are we bringing new money to problems, or are we simply trading, investing in the public markets? My strong preference would be to include additionality as a core component of impact investing. In other words, bringing new money to solving existing problems, as opposed to buying into companies, so replacing someone else's capital rather than bringing new capital.
Good.
But I think, Dilara, though, I think there are many other. I think there are other factors in all of this as well. I mean, impact is also about the way in which those businesses are managed. So what are the ways in which organisations? I think it would be a reasonable thesis to say we're buying into a company, and we're going to use our influence as an investor to try to drive through positive changes in the way that, let's say an organisation is being managed. And here, I think again the decarbonisation issue is a good example.
It's probably a little bit more difficult to demonstrate, no? That after you, as an investor, buying company's assets, that the company changes its way from more polluting to less polluting.
Correct, and more difficult to attribute. So you're making a contribution, but to what extent could you then attribute that change to
Yeah.
yourself, and in comparison to other investors?
And so there is another point to this additionality or intentionality. Would the project exist anyway if you invest or not, right? Because it's possible that it's a new project, you bring new capital, you don't replace it, but the company doesn't lack any capital to make this project. What is your thought about this?
What you're doing here is sort of you're going you're going directly to the challenges in relation to, you know cause and effect. And it's, in a sense, it's for these reasons why I think, the clearest line of sight to impact is achieved through new capital in new organizations or growing organizations. And there, the relationship between the capital and the action is quite clear to trace. I think the larger the organization, the broader base of the investment, the more difficult it becomes to directly attribute impact to a particular investor. And it's for those reasons that I think, as I said, the greatest clarity and the clearest line of sight that you have to impact is through additional capital.
Mhm. So you mentioned that the impact investing sector itself is doing something to limit the impact washing. So what are these initiatives?
Well, this is really being led, I guess, by the development of standards and codes of practice. So, to give you a couple of examples of that, in 2021, the International Sustainability Standards Board was formed, and the ISSB is, in a sense, it's analogous to the International Accounting Standards Board. So it sets out sustainability standards to be followed by the private sector. Its focus has been predominantly on climate-related reporting and disclosures. But there, this is a question of saying, well, this is what we require companies that comply with the International Sustainability Standards Boards to report on. So therefore it sets out a reporting framework and a disclosure framework for businesses to follow. So that's one example of a way of standardizing practice and reporting. Another example, which was launched slightly longer ago, I can't remember exactly when now, but I think it was 2017 or 2018, are the operating standards for impact management. And these were launched, and I think well over 100 large investors have now signed up to these. And these set out a sort of code of practice for investors to follow if they abide by good impact management standards. So those standards require them to report on their impact. They require them to measure the impact that they're achieving. They require a process of external verification or an assurance process that the way in which they are reporting is accurate, and so on. So these are examples of, I guess you'd call it self-regulation in a sense, but about people within the impact investing community saying, this is how we are going about providing assurance to our stakeholders that we are practicing what we preach. At the moment, impact investing is not regulated as such. But again, though, there are moves among many of the IOSCO members, securities regulators, and so on, looking at the way in which impact investing is being regulated, and I would expect there to be further developments in that area, so that the whole framework around which organisations, manage and report on impact is becoming much stronger and much more rigorous. There was a time, I think it's fair to say, and indeed this is how it was when I started, when it was all about anecdote. Oh, I've made an investment in a company, that company's grown a lot, isn't this smart, and it's created 40 jobs, 50 jobs, 500 jobs. This was the kind of level of reporting. And here's an example of how this business has grown over time. What we're seeing now is a much more rigorous and quantitative approach to impact management and impact reporting. And I think we're going to see that develop further.
Do you think that the regulation is a good thing in this sense?
I think I think we need it if we're going to start offering impact investing products and services to in the market. I think one of the things which has characterised impact investing thus far, beginning to change now, but it was sort of the preserve of foundations of philanthropy, of development finance institutions, and so on, who can essentially make their own rules because they're investing their own capital. What we're now seeing are institutional investments and asset managers and so on starting to offer impact investing products to the market. And I think when you start doing that, that's the point at which you have to have a greater level of scrutiny precisely to guard against these questions of greenwashing, impact washing, and so on. What we don't want to do is start to offer impact investing products to the public, and then have and then to find that actually that's just a wrapper, and it doesn't do anything to actually change the sort of behaviour, or there's no science behind the way in which that organisation functions, and there's no oversight of what that organisation is doing with the funds that it raises on that basis. So I think the answer to your question is yes. I think it is important, particularly when you're talking about offering products, to the market as a whole.
And it seems we're going in this direction. So there was a recent report by the 2 Degrees Investing Initiative, and they show that about 70% of the retail investors are interested in having impacts with their investments. And at the same time, there is only like about 1%, even less, of the financial products that can offer such a possibility. So, and you're totally right. If there is no regulation, there is nothing that defines clearly what impact investing is. We very quickly can fall into the impact washing and the opportunism instead of like a really good investment tool.
Yeah, indeed, and it would be very it would be very bad if that were the case. Impact investing, I think it's more than just kind of reporting on impacts achieved. I think that's an important part of it, but I think it's more than that. It's actually a kind of challenge to the way in which we fundamentally think about investing. Traditional investing has been built on this sort of concept of the primacy of financial return. Financial return is everything, and you live or you die on the numbers that you achieve. And I would count myself among people like this. I think that there's now a sort of growing recognition that actually that's not a very healthy way to approach the social problems that we have. The problems that come with the with increasing global population, the problems that come with planetary boundaries, the problems that come with consumption, the problems that come with inequality. That a sort of single-minded focus on financial returns is not a system which is likely to lead us, which is likely to be sustainable forever. It's this whole question of the whole question of growth, I suppose. At what point does the growth that we pursue and measure in this narrow way, measure just in terms of financial returns, at what point does that become an unsustainable model for the planet that we inhabit, and for the diversity of community and population that we have? And I don't think there's necessarily a right or a wrong answer in this, but I think that we have to find ways which respect planetary boundaries and respect the sort of state of the planet for the future. I think these are really important questions, and I don't think that they're being well served at the moment by the sort of dominant economic model that we have.
Yes, absolutely. And maybe actually let's make a step back. How did the concept of impact investing was born?
How was it born? There have been there's been experimentation with among investors for considerable length of time, well before the naming of impact investing. So, I mean, I think the creation of the development finance institutions, for example, um, recognised that there was a need to um, to invest in emerging economies. That this was not just about returns. This was also about social good. Um, it was about positive. It was about sustainable development. I think the philanthropic tradition has a long history of doing of making investments um, for the benefit of communities. So you can look in many cases where philanthropic organisations have funded early innovation, scientific development, and they've done so out of a spirit of philanthropy as opposed to necessarily earning returns. So I think these questions of of doing good using the profits derived from investing has been around for a long time. Um, what I think impact investing is doing is trying to say, well, hold on, do we just need to is do we just need to follow the path of maximizing financial returns, or do we actually need to build purpose into organizations themselves? And that, I think, is where perhaps the difference has occurred. It's saying it's not good enough anymore. The problems are such that an approach of maximizing returns and then leaving the use of those returns up to philanthropists is not a system which is delivering the sort of change and the sort of future that we want to see. And I think that it was that if you like, um, led to the beginnings of the formalizations of the concept of impact investing.
Philanthropy and development institutions, they look for impact, but they neglect profits. They don't need returns. That's the philanthropic money. While impact investing, you're trying to marry profits with the impact.
Correct.
I still don't understand how an impact investor thinks about the financial performance.
Mhm.
Is there a sort of a primacy? Is there first, let's deliver social or environmental output, and then we make sure that the returns are appropriate? Is there still a trade off? How do you think about it?
Right. In a sense, I suppose there's always a trade off, isn't there? I mean, a business can always make a choice. It can pay its employees more and have happier employees, or it can choose to pay its shareholders more. It can invest for the future, or it can distribute profits to shareholders. I mean, there are always choices, there are always options facing the ways in which business utilize the capital that is available to them. So I don't see that necessarily our sort of our market system. I mean, our market system allows for those sorts of decisions to be made. There is no tried and tested um, methodologies. Impact investors approach this in a sort of similar way. Impact investors, they want to see a return on their capital. Many impact investors believe that it's possible to get market returns on capital and still generate positive impact. I think that's not quite the right way to think about this. And again, this is more my personal perspective on the sector. I think that what impact investors should be concerned with is maximizing the positive impact that they achieve through their investment portfolios. I think that's what people are looking for. But you can only maximize impact over the long term if the organization that you're investing in is itself sustainable and profitable and able to generate the level of capital investment in order to sustain its performance and increase its levels of performance. So I don't see these two things as mutually exclusive, but I do think that it's important that the investor adopts a strategy of measuring both elements of the performance. They have to measure the impact performance, but they also have to be mindful of the financial performance and whether or not the organization is generating the levels of profit that it needs to generate in order to reinvest, in order to meet the needs of its investors. I don't think this is necessarily the right way to think. I don't think you can necessarily separate profit from impact. I think the two are mutually supportive. The more profitable an organization it has, the more its products and services are needed by the market, right?
Well, I think it depends because you can think of a company which has high profits because it cut costs, because it pays less to the employees, because it pollutes, because it does all kind of negative things for the society, because it produces junk food, which leads to the health problems of the society, and
Correct.
still it can make a lot of profits. So I don't think it's how to say this divine coincidence that you are necessary will be doing well financially if you are doing good socially and environmentally.
Well, that is certainly true. And what you're speaking to now is something around is more around the very way in which we account for performance. So presently, all we do is we measure financial flows, right? So we measure outputs purely in terms of dollars and cents. We don't have a system for valuing, for example, emissions. So a company can be very profitable, and yet it can have very high carbon emissions. And the question is, well, if you then start to value externalities, then you can look at corporate performance. So what I think you're giving an example of is the weakness, in a sense, of financial performance as it stands at the moment, as being a representation of the performance, the impact performance of an organization, right? So let me just build that out for a moment. So one of the things which is being the impact investing community is looking at in great detail at the moment is the extent to which externalities are valued in the financial statements of the company. And there is actually an organization now called the International Foundation for Valuing Impact, the IFVI, which is looking to develop performance coefficients which monetize externalities and include those within the performance reporting of companies. So in other words, let's take a fossil fuel company as a case in point. A fossil fuel company is contributes through its activities a large amount of carbon dioxide to the carbon emissions to the atmosphere. Now, if we value those and we incorporate those into the financial performance of that company, then we get a very different picture to if we just look at if we just look at monetary flows. The question is, if we start to assign values to externalities, a junk food company, hesitate to use the example of Coca-Cola, but let's use the example of Coca-Cola. All of the sugar that go into the manufacture of Coke. What is the health cost of all of that sugar on Coca-Cola's consumers? Can we attribute a monetary value to that? And can we then attribute that cost to Coca-Cola's financial performance? If we did, we would get a very different picture of Coke's performance, right?
Absolutely.
So that now, obviously, we're talking here about accounting adjustments and so on. But many people who are a lot wiser and cleverer than me are now thinking about and now grappling with the issue of valuation, corporate valuation, based not only on monetary flows, but based on the aggregation of financial and impact valuation criteria. That, of course, then brings into question, well, there are a lot of costs associated with excess sugar consumption. Are we actually then, are governments then going to start saying to organizations like Coca-Cola, you're going to have to pay more tax, or you're going to have to pay sugar taxes, or you're going to have to somehow compensate for the costs, the social costs, which your operations are incurring, but not currently accounting for. So these are complicated questions, but they do perhaps get us closer to a situation where there is a direct connection between impact performance and financial performance. Because you're right to say, at the moment, there's no particular incentive for organizations to maximize positive impact over, or to even take that into consideration in terms of measuring their performance.
Let's say a startup which thinks about the high-tech meat alternative, right? So it can be pretty bad to humans' health, as most of this kind of product, but at the same time it can be considered as a solution to climate change, because it will reduce meat consumption. So would impact investor invest in such company?
Well, again, I bring you back to this question of what is the impact investor? What is their intention? So, what is the impact investor? How does this particular impact investor intend to create positive impact? If that investor was saying, my impact thesis is that we're going to create some positive benefits in terms of climate, because we're going to have fewer carbon emissions from livestock. That might be one thing. We're also going to look at the health consequences of moving from animal production to plant production, let's say, or synthesis. So those might be the impacts which that investor are looking to have.
Yeah, but it's a compromise. Okay, there is a positive environmental impact, but there is a clearly negative social impact because of the health problems related to this kind of food production. Because, yeah, it can be very high on calories, but maybe very poor on the nutrients. And therefore, it will bring you a lot of money, because this is something which is valued by the investment community, but it's a clearly compromise. Okay, maybe I am a bit too idealistic, so I'm thinking about kind of the ideal solution. So we know it's better to eat whole food instead of processed food. Okay, so let's go for this, and let's maybe find solutions that will solve the problems with the environment. So it will be plant-based, but on the other hand, it will be also healthy for the humans. But then the question is, will be it really profitable? Because it will be less processing, less technology, and so less profits potentially. And yeah, I'm probably requesting too much from impact investors.
No, but I mean, no, but the thing is, these are really good questions, because I suppose they go in a sense to the heart of the matter, isn't it? It's what are the things that we can do, and investors can do specifically in the way that they allocate capital, which build a better world. I mean, that's fundamentally, it seems to be the question. That's the promise of impact investing, is we can use capital in a better way than we're using it at the moment, and we can create a better world by doing that. And when I say a better world, I mean a world in which, to take two big examples, a way which respects the planetary boundaries, which I think is really important. We do what we can to minimize the adverse impact of climate change. We do what we can to eliminate the reduction in biodiversity. We build a healthier environment, and we also build a healthier society. What can capital do to help drive that change? Because I think the broader question is, if capital doesn't do something itself, then governments will have to do things about it. It's either or. If we continue down a path where we are seeing increasing inequalities, that cannot continue forever, because it will lead to serious social challenges, and that will involve governments having to address it. So I suppose the question is, what can capital do? What can the investment world do in order to make the necessary changes so that we don't have those changes forced upon us, either through conflict or through other adverse forms, rather, of change and rebalancing. So that's what I would say. So what we're trying to do here, and I mean, this goes right back to what we said, what I said to you right at the beginning of this, which is, how did I get into impact investing? Well, I got into impact investing because I wanted to see people in lower income countries having improved opportunities. I thought that was important, partly through natural justice, but I think that's also socially, it's also geopolitically important, because I think if you have very large inequalities, as we do at the moment, between countries, between communities, between regions, that is not, in the long run, a sustainable state of affairs. Will impact investing work? I don't know, but I think it's important to try to see whether or not we can find a way forward which is better than the system that we've developed over the last 200 years.
How can we make it available to the institutional investors and then also to retail investors to respect the risk constraints?
Yes, well, the answer is we can't yet. Many organizations are now trying. So there are examples now of impact investing funds or investment trusts which are listed on public markets. We're beginning to see example of impact investing product development, which is making it available as a sort of asset type to retail investors. But it's only that's really only happened in the last year or two. I think it's going to take quite a while before we see impact investing in the mainstream. And I mean, part of the reason for that is that I think, financial regulators will need to take a view on the extent to which they want to regulate the business of impact investing. So are they willing to allow asset managers to offer impact investing products without a form of sort of formal regulation? Well, we'll see. We'll see. I'm not sure what the future will be there. Equally important, if not more important, I think, is the question of pension funds, because pension funds are so large, they are so significant. They're such significant institutional investors. They're investing all our funds, and I suppose the question is, at what point do pension funds start to take into account impact in the way in which they deploy the assets, the pension fund assets? That is probably going to take longer, because I think because of the nature of the rules in which they operate under, the maximization of financial returns being part of the fiduciary duty that the pension fund trustees have to the owners of the pension funds. Change is gradual. I wouldn't expect to see major changes in the next 2 or 3 years, but I think it's important that I think it will become increasingly important and increasingly evident, the owners of pension funds, that their wishes are taken into account. If you look at France, for example, there is an option in France, I think, where you can opt to have 10% of your pension contributions managed in a way which recognises positive impact. I think we may see these kinds of asset allocations growing in sort of in popularity, but it does, of course, put pressure on too, because the desirability of having more funds allocated to impact But if the financial performance of those funds is well below other products on the market, that will pose a challenge. There's no question about that.
There are different ways how the future can develop. One way it could be that if we are more consistently integrating the ESG values into the investment, and the investors take an approach of valuing not only financial return but also the social and environmental impact, maybe we don't need to the same extent impact investing. It can be one niche of financial investment, but what we need is, yeah, it's rather like global shift in the way investments work.
Correct.
In this case, maybe actually both will also somewhat balance, right? Because once financial investors, any financial investors, start taking into account all the externalities, their returns can either go down or up, but they will align with the impact investors' returns.
Agreed.
Just maybe a couple of words about blended finance. Can you say what it is, and if you think there is a future in it, and also especially in future in it in developing the impact investing further?
Blended finance is where you put together different types of capital. You blend them together so that you're able to, and typically what that means is it means you take capital from a public or a philanthropic source. Let's take an example here of a foundation. A foundation, a charitable foundation, might say our objective, what we want to do is create jobs in a particular place or a particular region or a particular country. We've identified the fact that there's not enough capital flowing into that economy. We're going to use some of our money. What we're going to do is we're going to try to have other investors come in alongside us. To make it attractive for other investors, we're going to guarantee their investment, let's say, or we're going to take a first loss. We'll take a first loss on our investment so that they don't have to lose so that they don't lose their investment. So essentially, it's a way of using a kind of subsidy. If you like, blended finance is in a sense, it's a form of subsidy, which is basically saying, let's use cheap capital, concessional capital that doesn't require a full return. Let's use that as a way of attracting in conventional capital, typical institutional capital. In a sense, it's sweetening the deal.
How do you see the future of this, or like the current development?
It can be useful. I think its performance to date has been quite disappointing. I don't think blended finance really leads necessarily to any change in behaviour. I think if you had a theory of change around this, you would probably want to say, okay, we think the market is pricing the risk too highly. So what we're going to do is we're going to use a blended structure to help attract in some capital. And when that capital comes in, it will see that, in fact, the risk isn't as high, and therefore that capital will be more willing to invest on its own in the future.
So it's like to put the first step, try this approach, and maybe next project will be financed by the private capital itself.
And I don't think as yet that theory of change has been proven. I have actually got some experience with blended capital, and I think there's another challenge which comes with blended capital too, which is around the alignment of interests between investors. So I think very often the provider of the concessional capital, the subsidy capital, will have a slightly different objective to the provider of the institutional capital. And I think that what that can do at times is to lead to a misalignment of interests between the investors involved, and which can be problematic.
And so you said you already had experience with the blended finance. Didn't it work well, or not as good as you expected?
I think probably not as well as we'd expected, but it's a very young asset class. And I think that the model that we used was not particularly successful. And I think the reason for that there was perhaps a misunderstanding around the ultimate interests of the investors concerned. And as a general rule, the simpler the capital structure, the better. So I think that when you start to put together capital with different structures and different costs, when you start to aggregate them in a capital stack with different rights and so on attached, I think you are increasing the risk of misalignment between your investors.
It's like this financial products that led to the financial crisis in 2009-10, right?
It would perhaps not quite as severe as that. You're making make life more complicated.
So what would be your recipe to grow impact investing?
I think ultimately it's all about performance, and I think impact investing needs to be able to demonstrate that it is able to live up to its promises. And when I talk about living up to its promises, I mean both in terms of achieving the financial performance which it promises, but I think also managing and measuring the impact that it's achieving and being clear about doing that. Ultimately, that is how that will be the test for impact investing.
Mm-hmm. Can you give an idea of what the financial performance of impact investing is currently?
It's very difficult. It's very difficult because we're still dealing with such a young asset.
So most of the time we say return, but we mean return, but also risk.
The direction that I would like to see impact investing going in is to say it's a question of risk, it's a question of return, and it's a question of impact. And we need to find a methodology which measures impact investment across those three determinants of performance, instead of just the two determinants which typical market uses, just risk and return. So let's find a way, and I think in that regard, the most promising model through which we can sort of integrate impact, risk, and return into a coherent model is to look at things around impact accounting. So how do we actually account? How do we incorporate impact into the returns, into accounting?
Should impact investing walk the talk and also have value sustainability in their personal life?
You have to, I think, be consistent if you want to have credibility. And I think if you behave in a way in your private life which is very different to the way that you conduct your public life, I think you will suffer. You suffer from a lack of credibility, and you'll be open to criticism. I don't think the two are necessarily. I don't think it's necessarily the case that. I think this is a case where optics become very important. If you don't walk the talk, you will weaken your credibility, and you will dilute the power of the message that you're trying to get across.
How sustainable is your lifestyle?
My impact philosophy is more about creating opportunities for other people than it is necessarily about planetary boundaries or so. So I use public transport. I'm predominantly vegetarian, though not exclusively vegetarian. I do have children. I have added carbon producers to the world. I certainly wouldn't hold myself out as a great exemplar of perfectly sustainable behaviour. But I think it is a responsibility. I think we do have a responsibility to try to be mindful and be sensible about our footprint.
What would be your two most inspiring books that you would like to recommend to the listeners?
I think, to be honest with you, perhaps the first one I would pick in terms of a genuinely inspiring and sort of mind-opening book that I read. The first one would be a book by James Lovelock. So I found Gaia quite inspiring, actually, because it spurred me, not only because of its own content, but it spurred me to read quite a lot of other books about the state of the planet. And the second book was called Bury the Chains. And that is a book about the abolitionist movement, the slave trade abolitionist movement that began in the UK in the late 18th century. Bury the Chains. So from a sort of historical and environmental perspective, those would be my two choices.
Thank you very much, Tom.